how do you actually invest your money into the right thing without having to put in a whole bunch of time, without having to take on all the risk. That way you can get the benefits from the growth of the economy without having to worry about your investment going bankrupt. This is a chart from Macro Trends showing the stock market, more specifically the S&P 500 over the last 90 years. And what you'll see is that the market goes up and down. In the early 1930s, we had the Great Depression, we had the market crash. But then in the 1970s, we had another market crash because of the high inflation and the slowing economy. This was an era of stagflation that really hurt the economy. In 2001, we had the dot-com bubble burst. You can see the market crash again. In 2008, we had the real estate meltdown. But after each time, you'll see that the stock market recovered. Some companies went bankrupt, but the stock market overall recovered. Our economy goes through booms and busts. It's a part of our economic system. We have seen recessions happen in the past, and they will continue to happen. And along with these recessions come market ups and downs. And what you have to remember about this is when you go through these economic swings, some companies will make a lot of money, and some companies are going to go bust. And if you want to be able to make your money without having to take on all the stress, but just owning a piece of the economy, owning a piece of the market, there are ways for you to do that. That way now you don't have to worry about individual companies. And this is now you going out and investing in funds or baskets of companies. That way now, in case one company goes bankrupt, you're protected because you have other companies in this fund as well that are making money while others are losing money. Let me give you a few examples. These are a few of the most popular ETFs, which is a type of fund. I'll explain the different types of funds in just a minute, but these are a few of the most popular types of ETFs on our stock market. Now, I'm not telling you what to invest in. I'm giving you these as an example, and I want you to remember that investing has risks. You are never guaranteed to make money when you invest. In fact, you will lose money at some point, so make sure you always do your own due diligence and never blindly trust a random guy on YouTube. So now let's go through this. This is a fund, VTI. This is an ETF that gives you exposure to the total stock market. So now when you go out and you invest in one share of VTI, and you can do this on pretty much any stock brokerage, now you're buying a little bit of pretty much every company on the stock market. So with this one ETF, you're essentially buying the American stock market. Then you have SPY. This is one ETF that gives you exposure to the S&P 500. Just a second ago, I showed you a stock chart. This was a stock chart of the S&P 500. The S&P 500 is an index, meaning a group of the 500 largest companies on the stock market. So now when you go out and you invest in a fund like SPY, what you're doing is you're buying a little bit of the 500 largest companies on the stock market. So now if one of those companies in your fund goes bankrupt, this fund will automatically kick that company out and put another company in. Then you have funds like DIA. This is an ETF that gives you exposure to the Dow Jones Industrial Average. This is one of the most popular and the most well-known and one of the most historical types of funds out there. The Dow Jones Industrial Average is a group of 30 different types of companies on our stock market. Then you have funds like QQQ. QQQ gives you exposure to the NASDAQ 100. If you've ever heard of the NASDAQ before, this is another very popular type of fund, and this gives you exposure to some of the largest non-financial companies on our stock market. That's why for the last couple of decades, QQQ has been very popular and heavy on the tech side of things because tech companies have grown so big, but this gives you exposure to the NASDAQ. And then you have things like SPYD, which gives you exposure to dividend-paying companies in the S&P 500. So for those of you who are like me and you like investing for cash flow, this is investing in companies that are paying dividends but are a part of the S&P 500, meaning it's one of the 500 largest companies in the stock market. But the goal here is to invest in companies that are paying those dividends, meaning cash flow, meaning now you're getting paid every quarter just for owning these companies as opposed to trying to see that price growth with the companies. And that's a little bit more advanced. I'm not going to be getting into what is a dividend, how to invest in dividend-paying funds and companies in this video. I'm going to be focusing more on the fund side, that we understand that there are different ways for you to be investing your money. Now, what you want to understand here is that the way that you make money, the way that you actually see the most success as an investor in these types of funds is not by going out and putting $1,000 into one of these funds and just letting it sit there. The way that you actually build wealth with these types of funds is, number one, you want to make sure your investments are consistent. Number two, you want to make sure your investments are passive. And number three, you want to make sure your investments are automatic. I like to call this CPA, consistent, passive, and automatic. And what this means is now every time you get paid, whether it's every week, every 2 weeks, or every month, you want to have a CPA, consistent, passive, and automatic system where every time you're getting paid, some of your money is automatically going to be invested into your portfolio of funds. For me, I have a system where every Wednesday, cash leaves my checkings account and is automatically invested into my portfolio of ETFs. Now, I invest in ETFs that give me exposure to value. I have ETFs that give me exposure to dividends. In fact, dividends are the largest fund piece in my portfolio of funds because I like cash flow. I have ETFs that give me exposure to emerging markets. These are companies and countries that are overseas that don't rely on the dollar. And I have ETFs that give me exposure to innovation. That's a smaller piece of my ETF pool because, well, that's more risky and that's kind of more on the fun side of things. This happens consistently, passively, and automatically. It doesn't matter if the market's going up or the market's going down. It doesn't matter if the market's booming. It doesn't matter if the market's crashing. This is going to keep happening, and this is happening for the long term. This is not something I'm doing for 6 months or 6 years. This CPA method of investing in these types of funds to build wealth is something you need to plan on doing for decades. That way you can build true freedom through the stock market. Now, you got to figure out how much money do you want to invest in stocks, how much money do you want to invest in real estate, how much money do you want to invest in your own business. But if you're getting paid, like I own Briefs Media, that is my company. I'm the CEO and I run that company, but I get paid a salary out of that company. Now, out of the salary, a big chunk of this is being CPA'd, consistently, passively, and automatically invested into my portfolio of funds. So whether you are just an employee or a business owner, this is the way now for you to take the income that you're making as a worker, because I'm a worker as well. You take this money you're making as a worker and now you can invest a piece of this into these funds. That way you can build this long-term wealth. You have different types of funds for pretty much anything that you can think of. Like you have funds for all the things that I just talked about. You have funds that are specific to real estate stocks. You have funds that are specific for healthcare stocks. You have funds that are specific for dividend-paying companies. You have funds that are specific for technology. You have funds that are specific for specific countries. Once you know what it is that you want to invest in, well, now you can go out and start investing in these funds. But you also want to be cautious about spreading yourself too thin and creating a portfolio of 45 different types of funds. Start simple, start small, understand what the bigger funds are, understand what you want to invest in, and then start investing your money and just don't dilute yourself too thin. If you enjoyed this clip and you want to continue your financial education journey, I have another video that I think you'll love. All you got to do is click that button right over there. And for those of you who want to stay up to date on the top finance and business news, you can join Market Briefs, my free financial newsletter, by clicking that button below. Thank you for watching, and I'll see you in the next one.